The $73 billion mortgage, Broadcom's $73 billion AI backlog, is not a projection. It is a legally binding mortgage on the future of the hyperscale cloud. While the retail crowd chases NVIDIA's volatile hardware cycles, Hock Tan has spent the last year quietly signing multi-year custom silicon deals with Meta, Google, and now OpenAI. These are not speculative partnerships. They are long-term supply agreements that position Broadcom as the inevitable toll collector for every company trying to build an alternative to the NVIDIA tax. By securing these contracts through 2029 and beyond, Broadcom has effectively locked in its status as the infrastructure landlord before the first floor of the sovereign AI cloud was even finished. This is about the shift from GPUs to custom accelerators. The custom silicon monopoly. In May 2026, the numbers tell a story that the marketing slides won't. Broadcom's AI semiconductor revenue grew 106% in the first quarter, hitting $8.4 billion. This isn't coming from selling generic parts. It's coming from Meta's training and inference accelerator and Google's 7th-generation TPUs. Broadcom now controls 70% of the custom AI accelerator market. For a hyperscaler, building your own silicon sounds like independence. But when you use Broadcom's IP and design services, you've simply traded one dependency for another. They are the only shop in town with the scale to deliver 3-nanometer designs at a volume that matters. If you are not buying from Jensen, you are likely paying Hock. The Ethernet choke point. Networking is where the real margin capture happens. Broadcom's Tomahawk 6 switch, released recently, is the industry's answer to NVIDIA's proprietary InfiniBand. The Big Five cloud providers are desperate to move to open Ethernet standards to avoid being locked into a single vendor ecosystem, and Broadcom owns the Ethernet roadmap. It's a classic squeeze. By controlling both the custom chip inside the server and the switch that connects 100,000 of them together, Broadcom dictates the total cost of ownership for the entire AI cluster. Critics argue that Marvell is gaining ground, but with Broadcom's current backlog, the competition is fighting for scraps, while Hock Tan harvests the core. The networking segment alone now represents a third of their total AI revenue. The VMware Subscription Tax. The May 2026 launch of VMware Cloud Foundation 9.1 proves that Broadcom isn't just a hardware company anymore. It is a software extraction machine. While VMware's standalone revenue growth looks anemic at 1%, the move to force customers into a full-stack subscription model is generating massive, predictable cash flow to fund their high-cost chip R&D. Broadcom is positioning this as a private AI platform, but look at the P&L and it's clear. They are raising the floor on entry costs for any enterprise that wants to run on-premise AI. They've shifted implementation to partners to strip away OpEx and maximize their own margins. It's a ruthless prioritization of profitability over volume, the part no one wants to say. Broadcom has successfully decoupled itself from the hype cycle by becoming the plumbing of the AI era. While we focus on the custom silicon and the Tomahawk 6 networking, the real takeaway is that Broadcom is acting as a private equity firm that happens to manufacture semiconductors. They have built a portfolio where the hardware lock-in from Meta and Google fuels the software lock-in from VMware. For operators and investors, the indicator to watch isn't whether the next large language model is better, but whether Meta's capital expenditure guidance continues to favor internal chips over merchant GPUs. If that trend holds, Broadcom's path to $100 billion in AI revenue by 2027 is essentially a math problem, not a vision. The risk isn't technical failure, it's a slowdown in hyperscale spending that would leave their massive backlog vulnerable. Keep your eyes on Meta's July CapEx update for the next real signal. Subscribe for more.